Welcome to this explainer. Today, we're unpacking a brand new deep dive report on the investment case for S&P Global. We're going to strip away all the noise and figure out what the data is actually telling us about the future of this financial infrastructure giant.
So let's kick things off with the ultimate question. Is this massive market leader, which is currently sitting at roughly a $122 billion valuation, truly worth committing your fresh capital to today? It's a company with incredible heritage, famous globally for its ratings and indices. But as we're about to see, the headline story doesn't always match the underlying machinery.
Taking a look at this chart, you can clearly see the reality of their business model. It's a stark barbell structure. On one side, you've got the absolute crown jewels, the indices and rating segments. Notice how their profit margins are sitting comfortably way up in the high 60s. They operate like toll booths on global capital. But then on the other side of that barbell, you have the market intelligence segment. It makes up a huge chunk of revenue, sure, but it operates at a much lower 20% margin. It is an intensely competitive space. So when you buy this stock, you're really getting a mix of both exceptional and, well, merely ordinary economics.
This brings us to the evolutionary pivot, specifically how management has been designing this complex portfolio over the years.
If you look at the timeline here, you'll see a deliberate, proactive strategy playing out over the last decade. They haven't just blindly built an empire. They've actually been pruning non-core assets, like exiting education back in 2013, to hyper-focus on financial infrastructure. Then there was the massive 2022 IHS Markit merger, which drastically expanded their footprint. But let's be real, it also added a ton of complexity. And now they're reshaping the puzzle all over again, with the planned mid-2026 spinoff of their mobility division under new CEO Martina Cheng, basically trying to leave only the absolute most profitable pieces on the board.
Which sets up perfectly what we're calling a tale of two moats, core power versus the adjacency grind.
Now, what's incredibly interesting here is how uneven their competitive protection actually is. On one hand, you have those core ratings and indices. These things have deep regulatory embedment. We're talking trillions of dollars directly linked to their benchmarks. Plus, they require very little capital to grow. It's just a beautiful, almost effortless compounding math. But on the other hand, you have their growth adjacencies, like market intelligence. This side of the house requires massive M&A spending just to stay in the game. They're constantly having to buy up new data sets, which creates a really heavy amortization burden. It is an absolute grind compared to the effortless power of their core business.
And when we compare client retention metrics to industry peers, well, a mild yellow flag pops up. Notice the stark gap here. Rivals like FactSet and MSCI proudly broadcast retention rates well above 90%. But S&P Global? They completely omit their enterprise retention numbers. Now, okay, this doesn't automatically mean their retention is terrible, but it absolutely means management prefers to highlight metrics that flatter their growth narrative, rather than giving us the full, transparent picture on client stickiness, especially in those highly competitive adjacency markets.
That kind of opacity leads us right into the AI dilemma. Will artificial intelligence be a catalyst for them or lead to pure commoditization?
Just listen to the company's own words on this. Management's explicit risk disclosures actually admit that AI could reduce the scarcity of data aggregation. Think about it. If anyone can use AI to instantly pull and organize financial data, the value of S&P Global's lower margin data products could be directly threatened. It's your classic innovator's dilemma, right? Does AI make them faster and better, or does it literally just turn their data into commodities?
And this is absolutely vital because S&P Global's bullish medium-term targets, where they're aiming for 7 to 9% organic growth, rely heavily on monetizing AI and expanding into private markets. They're basically asking the market to assume seamless execution in these brand new tech frontiers. But we have to be realistic here. These projected revenues, they aren't yet the proven, unstoppable compounding streams we see in their legacy index business. Right now, they're still just narratives waiting to be proven.
Moving beyond the tech risks, let's look at governance and accounting and take a peek beneath the math at some operational flags.
Look, S&P Global is a cash-generating machine. There is zero doubt about that. But management heavily relies on non-GAAP or adjusted metrics. This preferred framing conveniently ignores the massive billion-dollar annual toll they pay in amortization for all those acquisitions. For a serial acquirer, these aren't just one-off costs, They're the recurring price of admission to maintain their strategic breadth. By adjusting them out, the earnings look far cleaner than the actual messy reality of their strategy.
And honestly, this skepticism extends straight to leadership. We recently saw a significant drop in shareholder trust, with their say-on-pay vote plunging to roughly 68%. Why?
because investors pushed back hard on a controversial executive severance package during a recent leadership transition. It puts a real dent in the idea that management deserves unquestioned trust from shareholders right now.
This brings us to valuation, which brilliantly illustrates how the market is weighing all these factors. S&P Global is trading at roughly 21 times forward-adjusted earnings. Now, on the surface, compared to premium peers like Moody's or MSCI trading at 30 times or more, it looks like an absolute bargain. But it's cheaper for a reason. Investors are correctly pricing in the risks we just talked about: the messy transition of the mobility spinoff, the heavy reliance on adjusted accounting, and that huge exposure to lower-margin, highly competitive data businesses.
So, let's pull all of this together for the final verdict. A great business, but a skeptical setup.
To make this stock truly investable right now, the report argues we need to see three specific things change. First, we need evidence of a clean execution on the mobility spinoff, without any lingering stranded costs. Second, we need real, hard numbers showing AI is actually driving revenue rather than just looking good in slideware demos. And third, we need a much more attractive entry price, one that doesn't force us to pay a premium for perfect execution on their riskier adjacency projects.
Ultimately, S&P Global is much closer to being a great business than just a good one. Those legacy moat businesses are undeniably powerful. But given the AI uncertainties and the accounting adjustments we've covered, the report concludes this is a stock for the watch list, not a fresh commitment of capital today. So I'll leave you with this thought. When you're looking at legacy giants pivoting in the age of AI, is this the right moment to buy the dip, or is the smartest move simply waiting for the dust to settle? Thanks for joining me for this explainer, and keep asking the hard questions.